Well, if the Fed was wrong and there was actual temporary inflation, they would have caused a crash in asset prices even though maybe they didn't need to, at least according to the Fed's theories. So what did they do? They kept waiting and waiting and waiting, and then it became much worse. We saw 8.5% inflation, and that's when the Fed said, okay, inflation is not transitory, now we're going to take steps to fight it. And now here we are today with still inflation very, very high. It's starting to come down a little bit, but the Fed is still saying that this inflation is the supply chain, it is Russia, it's Ukraine, and so because of that, we don't need to get super aggressive to fight inflation, because what's the alternative? If the Fed did get super aggressive to fight inflation today, then they would for sure cause an economic crash. They would for sure cause an economic downturn. They could even potentially trigger a recession or a depression depending on how aggressive they got. And they don't want to prematurely do that because they don't want to gamble. They want to see what happens and then make a decision. Now the risk with this is what happens if it's too late. But they're hoping that that's not going to be the case. Now, practically speaking, what does this mean? If the economy slows down and we go into a recession or a depression, that means that asset prices go down, and that could create the opportunity for you to come in and buy distressed assets, stocks, real estate, crypto at a lower price, assuming that you can find a good asset. Now, on the other hand, if inflation does not get better, if we still have very bad inflation, then either the Fed will continue to fight inflation, which would hurt the economy, or they're going to turn around and say, all right, this is inflation and it is what it is. Inflation in general is good for asset prices. It's good for stocks, real estate, and crypto because people will take their cash and they will want to dump it into assets because they don't want to hold on to cash anymore. And so now hypothetically, if we're in a situation where inflation is still relatively high, and then we go into a recession or an economic slowdown, and then the Fed wants to start fighting the economy, they want to start fighting the slowdown in the economy, what do? Well, then they would stop the fight on inflation and start creating more inflation to help the slowdown in the economy, which then kicks the can down the road because now you don't want to see more companies go under, you don't want to see more bankruptcies, so you flood the markets with more cash, causing asset prices to crash upward, which creates more inflation, but at least you save the economy for the short term. Now, how long can you keep doing this? I don't know, but that is the possibility. If we see inflation, which is still high, while the economy starts to go down, then the Fed might be left with no option but to start stimulating the economy, meaning create more inflation, even though inflation is what's creating this recession. So what do? Well, you create more inflation to hopefully help the recession, which makes the inflation problem worse. So what does this mean for you more practically? Well, one, own assets instead of just holding on to cash, and be prepared to potentially buy assets if they go on sale. What I don't want you to do is try to get into the game of timing the market where you say, all right, you know what? The market's going to crash. We're going to enter a recession, and that's when I'm going to come in and I'm going to buy stocks at the bottom. Or I'm going to wait for the real estate market to crash, and that's when I'm going to come in and buy. I do not want you to try to time the market like this because there's so much uncertainty as to what can happen, and this goes to what the Federal Reserve Bank will do. Now, I have my own opinions on what the Fed should do. I think the Fed should be fighting inflation because I think if inflation gets out of hand, it'll be a much worse problem than going through a recession. We live in this weird kind of economy where we're trying to desensitize ourselves from risk, but at the end of the day, sometimes companies need to fail. If you are a company and you are not profitable and you cannot run on your own cash flows and you cannot run profitably, well, there will be times where these types of companies will fail, and you cannot just keep flooding the markets with cheap dollars because that will keep more bad companies being made. Sometimes these companies will have to fail. It's painful. It's painful when people lose their jobs, but that's what allows the economy to refresh, and that's what allows the economy to grow stronger and create more real innovation instead of just creating innovation run on cheap dollars. You have to build real products, and if you don't allow that to happen, you make much bigger bubbles, and that's when those bubbles burst, it makes a much bigger crash. And that's what can create real depressions. So we want to avoid that. And so, if you run into these type of inflationary issues, you want to take care of it as soon as possible, because if you ever run into a currency crisis, that makes everything significantly worse, because now not only would the economy go into shambles, but now even the currency goes into shambles. And, while we're still the world's reserve currency, we want to make sure that we protect that. We want to make sure we protect the dollar. We want to make sure we protect the economy. So sometimes that means we have to go through short-term pain. And, while it's not fun, it's kind of the price that you have to pay for a strong and healthy, long-term, sustainable economy. But going back to what I was saying regarding timing the market, it's really hard to try to do this, especially when you have the X factor, the Fed out there, because let's just assume now that we go into a recession. Things get bad in the economy, but then instead of continuing to fight inflation, the Fed now creates more quantitative easing. The Fed starts cutting interest rates again. Now, this might seem unlikely because the Fed says that they want to raise interest rates and they want to fight inflation right now. But if we start to see people losing their jobs, we start to see unemployment go up, well, then the Fed could change courses. And you might say, how can the Fed do that even though we have high inflation? Well, it just depends on what's the top priority at that time. Because if the Fed says, all right, you know what, this inflation issue will get worked out by itself, but the economy is the bigger issue right now. We don't want to see Americans lose their jobs. We don't want to see the economy slow down. So then they start stimulating. Well, now you try to desensitize that pain, you get rid of the pain, you print more dollars, but then you create a much bigger bubble. So it's hard to predict what's going to happen. It's hard to say that the economy or the market is going to do one thing, because the market is going to depend not just on the economy, but also what the Fed does. And that's a completely different wild card. And it's hard for us to really know what's going on in the economy, the real strength of the economy, because we're not going to know that until we start raising interest rates even more, because in June, this is when the Fed is now for the first time starting to reduce the size of their balance sheet. We don't know what the effects of that are going to be. That means that the Fed is now finally starting to sell off some of the assets, the trillions of dollars worth of assets, the treasury bonds, the mortgage-backed securities that the Fed started buying up back in 2020. Now, we don't know what the effects of that are going to be just yet. Are they going to slow down the markets? Is that going to slow down the economy? Is that going to change inflation? We don't know just yet, and it's going to take some time for us to really see what's going on in the economy. Of course, I have my own opinions, but we don't know what it's going to do exactly. And the Fed is going to act reactively. They don't act proactively, because if they act proactively and they start fighting inflation even more, that would preemptively cause a stock market crash and a real estate crash, and the Fed doesn't want to do that. Thank you for watching. If you enjoyed the shorter clip from my longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.